Guys, this is the S&P 500 technical analysis. If you look into the S&P 500 chart, then the previous week it was just up, down and this thing. Now what is noticeable here is that I told you that on Monday, if there comes a candle on Monday where the closing of the candle is above the Ichimoku cloud, then technically S&P 500 will remain bullish, and because there will be two consecutive closings above the Ichimoku cloud, this means that there will be some good probability of the S&P 500 to move up, and even if it fails to move up, then also it will be reluctant to come down, and in order to come down it has to see some very heavy selling. So on 2nd of August 2022, I have recommended my members that you see there will be a gap down open and S&P 500 will come down immediately upon open. That will be an excellent opportunity for you to buy. So you can buy here and then wait for the retrace. 100% there will be a retrace, and when you see the retrace, then you can book your profits. Now what did not happen? That was the profit booking. Last week I told you that on Monday there will be a very heavy probability of the profit booking. Okay, profit booking means that whosoever has fueled the market this upside, he is going to sell on Monday, and once he sells on Monday, then on Monday the S&P 500 it will come down heavily. Okay, but this profit booking it did not happen. Rather, there was a closing above the Ichimoku cloud. And this is what I mentioned in scenario number 2 or 3, that if you do not see the profit booking on Monday, and if for some reason if the closing it remains above the Ichimoku cloud, then the profit booking it will not happen and the S&P 500 will remain bullish. Anyways guys, so as you have seen that the movement of the S&P 500 or the SP500 index, it was as we have predicted last week, except the profit booking. Only the profit booking it did not happen, otherwise the movement was as expected. Now guys, I have divided the technical analysis in the 4 parts. So first I am going to discuss the job data. So I am going to explain that why the job data it was extremely bad for the stock market. Then I will do the weekly SP500 technical analysis. Thereafter I will do the daily S&P 500 technical analysis, and then at last I will reduce the probable movement of the SP500 for the coming week. And I strongly recommend to do not skip this particular part, particularly the job data. So this will help you understand what is going to happen in the stock market, not just the S&P 500 but in Dow Jones, Nasdaq, okay, and all other indices, and not just in the American market but all over the world. Okay, what will be the impact of the job data? So I'm going to begin with the job data, then I will do the weekly technical analysis of S&P 500, then daily SP500 technical analysis, and then the expected movement. So yesterday what happened is that earlier the stock market, the analyst, okay, everyone, they have predicted that there will be 250 or 258,000 jobs, that we will see that these many jobs have been added to the economy. However, surprisingly, the data that was released from the department, it said that there were more than 500k, more than 500,000 jobs added to the economy. This was more than 2 times much better than expected job data, as everyone has predicted in the stock market. So it was the surprise, not just surprise but an extreme surprise. This is good, right? This is good? No, this is bad. Now you may think, okay, that because there were more jobs added to the economy, so this is good. No, this is not good. This is extremely bad for the stock market. This is good for the economy, no doubt. This is good for the economy because more people are getting the jobs, but this is extremely bad for the stock market. And the reason is, last month Feds, okay, they went with 75 bps rate hike. Okay, in the month of June it was 50 bps. In the month of May it was 25 bps, 25, then 50, then 75. May, June, July. In the month of August, okay, there is no meeting, no rate hike. Last month the Fed chairman, he himself has accepted and admitted that the economy is not doing well and economy is on the brink of recession. But he said that economy is not in the recession. He said that the economy is on the brink of recession, and that was the reason, rather than going for 100 bps rate hike, the Feds, they have decided to go with the 75 bps rate hike. Now the 75 bps, it was something that the stock market has already accepted, and that was the reason why you have not seen a downward movement, but surprisingly this a very heavy manipulated upward movement and then up and up. Okay, so this was not through any technical. These three candles were not through any technicals. These three candles were formed only and only because of the verbal comments of from the Fed chairman. So this was the manipulation. Now for the people who have not subscribed to this channel and who are not watching these technical analysis, okay, for last many weeks, so let me tell them that that what is the impact of this the rate hike. Okay, see, whenever the central bank it raises the interest rates, this raise in the interest rates, it impact the banks, okay, and the banks, what they do, then they raise the interest rates on the loans. So you need to understand that how the banks they make money. Banks they make money on the loans. Okay, so the banks will give you the loans, the credit card. So credit card is again the loan. So banks will give you the loan, and then the banks will charge you the interest on that the credit card or the loan. And this is how the banks they make the money. Now when the central bank, okay, when the central bank it raises the interest rates, banks are forced to raise the interest rates, and when the banks raise the interest rates, your loans will be costlier. Okay, so this is one part. The second part is that when the central bank raises the interest rates aggressively, then banks are reluctant to give you the loans, because whenever the central bank raises the interest rates heavily, it is an indication of a economic slowdown, okay, generally a recession. And that is the time when the bank knows, okay, that if they give the loans to everyone, then the recovery of the loans will not be possible. Okay, so these are the two reasons. Number one, that the banks will raise the interest rates on the loan. Number two, that the banks will not disburse more loans. Banks will be reluctant to give the loans to everyone. Okay, so as such, to individuals, okay, it will not impact, but it will impact the businesses, because banks make a lot of money that they give to the banks. Sorry, the banks they give a lot of money as a loan to the businesses. Okay, businesses, and businesses they pay the interest, a lot of interest, and this is how, okay, so the businesses they give a lot of money back to the bank, and that is a major portion of the earnings for the banks. Now because the banks will give less money or less loan, or a very few loans, restrictive loans to the businesses, this means that businesses now will think of saving the money that they have or that they are making. In that case, businesses will go for the layoffs. So what will happen in this the layoff, the businesses they will fire the employees. They will simply fire the employees. Now when the businesses they fire the employees, so then these employees they will not be having any money to spend, or any money to buy the expensive thing. Okay, so now these employees means the people. So now the people they will think of buying only the necessary items, only the necessary things. And the same was clearly seen through the outlook of Walmart. So 2 weeks ago, Walmart has downgraded its yearly outlook for the entire year, for the 1 year. So the Walmart, okay, means you can go and buy each and everything that you need in order to survive. So Walmart has clearly seen decline in sales. Okay, and because there was the decline in sales in Walmart, so Walmart has downgraded its yearly outlook, and Walmart has said that people are not buying the unnecessary item, people are buying only the necessary item. This means that economic situation is not good, economy is slowing down. And as I mentioned, and as I'm mentioning, okay, for last many months, since the month of January, that we are going to enter into the recession. And now after after April we are in the recession officially. Okay, we may be in the recession like after November or maybe after December, but we are in the recession. And this is what something, okay, the Walmart has confirmed, the company itself through the data has confirmed. Okay, so this is basically the cycle, okay, the banks and the people impact, etc. So because the Federal Reserve, okay, last month the Federal Reserve was reluctant to raise the interest rates by 100 bps, because raising the interest rates by 100 bps last month would have definitely brought down the economy into the recession last month itself. Okay, so the Federal Reserve Chairman, he decided, means he and his team decided, okay, not to go with the 100 bps, rather to go soft, and soft was 75 bps. So this was not soft. This 75 bps is something that we have not seen in last 25-30 years. So last month, going with the 75 bps has clearly saved the economy going into the recession officially. I repeat, officially. Unofficially, the economy is in the recession. Okay, but officially it is not. And if you think that the economy is not in the recession, then just look around, talk to the people. Now because the number of jobs added to the economy, okay, are more than 2 times, okay, as were expected by the Wall Street. This means that Feds are going to raise the interest rates by 100 bps in the month of September. Now the major reason, like why the Feds are going aggressively, why they are raising the interest rate, what is the need to raise the interest rate? The reason is the inflation. Inflation is currently at 9.1, and now in the month of August it is going to hit the 9.5 or 9.6. Okay, this is what I have predicted in the month of April itself, April May, that it will hit 9.5 to 9.6. Then only we can expect some reversal. But because now the Feds are not meeting in the month of August, means they are not going to take any appropriate measures to curb down the inflation from 9.5 or 9.6. This means that in the month of September we may see inflation in the double digits that we have not seen, I guess, after 1975 or 77. Okay, so this will be something that we'll be seeing after 40 to 45 years. 40 to 45 years. Okay, so because the inflation is, and other than that, you need to know that the standard inflation rate, okay, that we consider good for the economy is 2 or 2.5 or 2.25. This is the standard inflation rate. So the standard inflation rate is 2 or 2.25, and now you can see that it is 9.1. So this is more than 4 times of the standard inflation. That is the reason why you are seeing everything, okay, is costly. And Feds are under pressure. The government is under pressure to calm down the inflation. Last year you were paying, I guess, $3 per gallon, okay, for the gas. Now you are paying 5 or $5.5 per gallon. So this is what the inflation is, and this is because of this, the 9.1 or 9.2 or 9.5. Okay, see, earlier when you were paying like $5 or $5.25, okay, that time the inflation was 8 or 8.5 or 8.6. Now it is 9.1, and now it is going to hit 9.5 or 9.6. This means that things are going to get costlier rather than coming down. So price is not going to come down soon. Price is going to move up, and that is okay. So for that we need this, the inflation index, okay, to see where the inflation is standing. So inflation is 4 times of the standard acceptable rate of 2 or 2.25. It is going to hit 9.5, 9.6, and 10, and that is the reason why Feds will be forced to go with the 100 bps. Now when the Feds they go with the 100 bps, it will force the banks, to hold the money, okay, and to raise the interest rates heavily. So for example, earlier, okay, let's say you were paying like just 1% interest rates for your loan. Now you will pay, or you will have to pay 2% or 3%. The banks will charge you 2 to 3% interest rates. So what will happen? Now you will see that the interest you are going to pay, it is more. Okay, economy is coming into the recession. Things are not good. So what will happen? So earlier you were thinking of getting a loan from the bank. Now you will simply drop the idea. Okay. Now because you have dropped the idea, you are not going to take the loan. So if you would have taken the loan, then definitely you would have used this money. Okay. So for example, you can use this money on a trip. Okay, abroad trip. Okay, or you can use this money to buy a home, okay, or car or anything else. But now because you are not going to take the loan, you are not going, okay, for this, the home, for the car or anything else. This means that the sales of the car company will come down, the sales of this, the home, okay, it will come down, everything will come down. When the sales will become when the sales will be less, the revenue of the companies, okay, it will come down. When the revenue will come down, so will be the profit. When the profit will come down, it will affect the balance sheet and the profit and loss statements of the company. Okay, when it will hit the balance sheet and the profit and loss statement of the company, it will impact the valuation of the company. Okay, so let's say there is a company, the valuation of the company is $100 billion. Okay, now because the valuation will it will be less, so the valuation will be like $70 billion. So now what will happen? The stock price of the company that is currently like $100, it will be then $70. Okay, now when the stock price of the company will be $70, because this company is listed in the S&P 500, this means that the S&P 500 will also come down by 30%. Okay, see, this is just an hypothetical scenario. I'm not saying that the S&P 500 will come down by 30%, but this is what I'm trying to tell you, that when the valuation of the companies will decrease, the stock prices of the companies will decrease, and when the stock prices of the multiple companies, okay, decreases, so will be the valuation of the S&P 500. Okay, this is the cycle. This is how, okay, this is the system it works. So we have talked about a lot of things, but again the question remains that why the much better is the economic, sorry, this the job data. Okay, that is more than 2 times what the Wall Street was expecting. Why it is worst? Why it is bad for the stock market? The reason is that the previous month, the Federal Reserve was reluctant to raise the interest rates because the Federal Reserve noticed that the economy is struggling. And if the Feds go with the 100 BPS rate hike, in that case, economy will come down into the recession immediately, officially, right? And the Federal Reserve Chairman multiple times, many times has said that he will look for the data. He will be looking into the data. He and his team will be looking into the data. And if the data is good, in that case, Federal Reserve will definitely, this is the kind of hint that he has given. If the data is good, then definitely the Federal Reserve will go for the 100 BPS, because whenever the data is good, so this time the jobs, okay, they were more than 2 times. This means the Federal Reserve will see that more people are getting jobs, so the economic situation is not bad as it was supposed to be, or as everyone was thinking of. This means now comfortably the Federal Reserve can raise the interest rates by 100 bps. Means in order to curb down the inflation, the Federal Reserve can go aggressive, much more aggressive, and not just this 100 bps one time, but back to back. Okay, so 100 and 100 or 175. So these are very aggressive interest rate. So when I say 100 bps, it means 1%. So this is the reason why the stock market is fearful, because raising the interest rate so heavily will impact the balance sheet and the profit and loss statements of the companies, because it will impact the sales and revenue and everything. When everything will be affected, okay, then the valuation of the companies, the valuation of the banks, and each and everything will come down. When the valuation will come down, and so will be the indices, so will be each and everything, means the stock market is not moving up, rather it is going to come down. In simple words, this is why this 2 times much better means much more than expected data. It is good for the economy, but it is extremely bad for the stock market. It will compel the Feds to go aggressive and to raise by 100 bps to put pressure on the economy. Now let's see the visible signs. This is the 2-year bond yield. This is the 2-year bond yield. Okay. In my previous technical analysis, so in my previous S&P 500 technical analysis, I have mentioned many times that whenever 2-year bond yield is more than the 10-year bond yield, okay, it is a sign of recession, confirmed sign of recession. Okay, whenever the 2-year bond yield is less than the 10-year bond yield, means the economy is doing well. Okay, as of now, if you notice that the 2-year bond yield, okay, it is 3.327%, and the 10-year, this is what, this is 2-year, okay, and the 10-year bond yield is 2.832%. So you can clearly see that the 2-year bond yield is more than the 10-year bond yield, okay, by a significant margin. I repeat, significant margin. This kind of margin we have not seen in last many years, when the 2-year was much more than the 10-year. So now the numbers themselves are confirming this thing. Feds are going aggressive, economy is going into the recession, things are going bad. Now what we need to see here is that other than this thing, yesterday when the data was released on 5th of August 2022, the 2-year bond yield, okay, it went up by 9.19%. 9.19%, very heavily. This was the last time on 10th of June when we have seen 10th and 11th of June, 10th and 13th of June when we have seen, such an aggressive upward movement in the 2-year bond yield. Now you will think of that I'm talking like this, the blah blah blah, the numbers, percentage, and this doesn't make any sense, right? Wrong. Let me show you. On 10th of August and on 10th of June and on 13th of June, it went up very heavily, just like 9%, 10%. What was the impact on the stock market? This is 9th of June. This is 10th of June. This is 13th of June. This was the impact on the stock market. So whatever I am telling you here, whatever I'm saying here is not that usual blah 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 or okay or some rubbish. This is something that you must consider, that you must accept it as a fact that what is going to happen. And this is because of the numbers, because the numbers are saying, okay, so this is what we are seeing, this is what we have seen last time, and this is now what, and this is now what we are seeing. But last time when it came down heavily in the month of June, the Federal Reserve was supposed to raise the interest rates in that month. The only thing that is different here in this case is that Federal Reserve is not going to raise any interest rate in the month of August. In the month of June, the S&P 500 and all of the stock market came down heavily. Okay, so this heavy movement, it was like how much percent? This heavy downward movement, it was from here, and you can clearly see around 10%. Within 3 days, the S&P 500, it came down by 10%. Now in this month, because there is no Fed's meeting, Feds are not going to raise the interest rate. This means the kind of downward movement that we have seen in the stock market, in the S&P 500, Dow Jones, in the Nasdaq, in the month of June, we may not see that movement immediately in the indices, because the Feds are not going to raise the interest rates in the month of August. Rather, they will raise the interest rate in the month of September. So when I say immediately, this means that you can say like on Monday, Tuesday, Wednesday, okay, etc. We may not see, but it will be definitely there. Sooner or later, it will be there definitely. So this is something that we will discuss through the weekly technical analysis and the daily technical analysis. So this is with the 2-year. So the 2-year bond yield, it went up by 9.19%, and this is the 10-year. The 10-year bond yield, okay, it went up by 5.28%. Now there is one more question, that why the bond yields are moving up. Okay, because of this, the news that the jobs, okay, the job data is 2 times more than the expected, and when the stock market is fearful. So you need to understand the logic behind this thing, and the logic is simple. Whenever the investors, the big ones, the hedge funds, and whenever they are fearful, whenever they expect something unexpected, whenever they are not sure what is going to happen in the stock market, or whenever they are fearful, then what they do? They do this thing. They simply pull out their money from the stock market and they pump the money into the bonds, because bonds are safe, because the Federal Reserve and the government is promising you that the Federal Reserve, okay, and the government, they will give you the rate, okay, this is the interest rate, 3 or 3.3%. So if you invest like $100 million, okay, then you will get 3% or 3.3% for sure, as per the commitment from the Federal Reserve and the government. This means you will get a profit of 3%. But if you keep your money in the stock market, the situation is not good. It can come down, okay, and a lot of bad things can happen in the stock market. If you do not pull out your money, then your portfolio, okay, it can come down by like 40%, 30%, 50%, 70%, may become zero. So you can lose like $100 million or $1 billion. But when you pull out your money immediately in an uncertain market and you pump it back into the bonds, okay, you will get an assured return. Other than the bonds, we have the gold. So bonds and gold are used to hedge. Again, hedge. So you have heard of this thing, the hedge funds. Okay. So that is, so these are so this is the hedge, the bonds and the gold. Bonds have so bonds, gold, and the property. Okay, etc. So there are these some things, okay, that are used okay, as a hedge. So what will happen, that if there is a hedge fund, okay, that has like $100 billion. Now this hedge fund, he will keep like, you know, 50 billion dollars in the stock market and will pull out the rest of the $50 billion from the stock market. Will okay, so it will simply pump like $20 billion or $30 billion in the bonds, 20-30 billion dollars, okay, 10-20 billion dollars in the gold, or $10 billion or $5 billion in the real estate, etc. This is how they are going to hedge. And whenever you know, whenever the situation of the market is not good, whenever the situation of the market is uncertain, whenever the situation of the market is uncertain, you will clearly see that the bond yield is increasing and the stock market is about to come. This is the relation between the bond yield and the stock market. See, generally you will not see, okay, this thing each and every day, but you need to focus on the big candles. Big candles are the indication. So guys, now we have covered the job data. So guys, now I'm going to do this, the S&P 500 technical analysis on the weekly chart. And once we are done with the weekly chart, then I will do the SP500 technical analysis on the daily chart. And through the weekly and daily technical analysis of S&P 500, we will come to know the most probable movement of the S&P 500, as we are doing for last many months. And the accuracy is again more than 80% through the weekly technical analysis, and more than 90% through this the S&P 500 daily analysis. But the daily analysis is exclusively for the members who have joined the YouTube membership. So guys, this is the weekly chart. Let me write it down. Weekly chart. Weekly chart means one candle represents 1 week, not 1 day or 1 hour. One candle means 1 week. Now let's do the S&P 500 technical analysis on the weekly chart. Now first comes the Bollinger Bands. This is the upper band of the Bollinger Band. This is the median of the Bollinger Band. Because the S&P 500 has closed in between the upper band and the median of the Bollinger Band, this means that SP 500 is bullish through the Bollinger Bands, right? Then comes the moving averages. If you see that there is a clear fan out that is supporting the bear trend, but because the SP 500 has closed above all of the moving averages, and this is the second time it has closed above all of the moving averages, okay, this is indicating that the SP 500 is bullish through the moving averages. However, the pattern of the moving averages, it is saying that the S&P 500 is still bearish. This means as of now we will say that through the moving averages the SP 500 is neutral, right? Then comes the Ichimoku cloud. If you see that this is the Ichimoku cloud, because the S&P 500 is trading below the Ichimoku cloud, this means that the S&P 500 is bearish through the Ichimoku cloud, right? Now let's talk about some other technical indicators. Some other technical indicators, first comes the MACD. If you look into the MACD, now because after many weeks, or you can say like after 4 or 5 months, so not 4 or 5 months, after 7 months, the MACD now it is bullish, because the K channel is more than the D channel. However, because both K and the D channel both are negative, thus on the broader scale, on the so if we look into the big picture, the SP 500 through the MACD, it is still bearish, okay. But directionally, okay, for this the short term, we will say SP 500 is bullish because the K channel is more than the D channel. Then comes the stock RSI. Now again a bad news for the market, again a bad news for the stock market, a bad news for the S&P 500, a bad news for everyone. And the bad news is, if you look into the stochastic RSI, the K channel is 100. The K channel is 100. And this was the reason why on Monday, on 1st of August, because the K was 100 on the daily chart, that was the reason why on Monday the S&P 500 it came down, and not just the S&P 500 but all of the markets, okay, they came down. And see, there was a reversal, but that was a different thing. but first it came down. That was because of this, the 100. Now on the weekly chart, the K channel is 100, which is more than the D channel, means it is bullish, but because the K is 100 means that the stochastic RSI is now saturated or is overheated, and because it is overheated, it is saturated. This means that the S&P 500 has to come down. Let me show you one more example. Okay, when we have seen such a thing here. So this was the week of 16th of May. In the week of 16th of May, the stochastic RSI, the K channel was zero, absolute zero. Okay, and if you have subscribed to the channel, then, and if you are watching my technical analysis for last many weeks, then you know what the 0 and 100 means. And again, guys, if you have not subscribed to this channel, then you can subscribe the channel so that you can get the timely notification of the weekly technical analysis. In the week of 16th of May, because the K channel of the stochastic RSI, it was zero. I told you, because it is zero, be ready to see a reversal. And now if you see in the picture, a very heavy bull candle, on the weekly chart. This means that in those 5 days, Monday to Friday, see, we are talking about the weekly chart. So from Monday to Friday, the movement was very heavy. This was the reversal. Now, because again the K channel is 100, this means now we can expect a heavy reversal. This is the downward movement. So this is how we interpret this. Now this downward movement will also be supported by the job data, that is 2 times more than expected. Okay, that's the downward movement. This means that the reversal, the kind of fall that we were anticipating earlier, so we can expect the fall in the coming week, in this week itself. If it doesn't happen on Monday, then maybe Tuesday, Wednesday, Thursday, okay, or on, but it is expected to happen in the coming week. So a reversal is going to be seen in the coming week, because the K channel is technically 100 and the technical data is saying that the channel is now saturated, right? So directionally it is bullish, but be ready to see a reversal. Now guys, again one more thing, do not forget that immediately you may not see the reversal, because the S&P 500 was manipulated in the week of 25th of July. So again the chances are that it can again be manipulated, means you can see that the S&P 500 is moving up. Okay, and whenever you see that the S&P 500 it is moving up, there will be very heavy chances that it is going to be a trap rather than a bull movement. It will act as a trap, because when the S&P 500 it moves up, and because these hundreds of thousands of retail traders, they are not aware about the technicals, okay, or this is the economic situation, this is the bond data, okay, this is the 2-year bond yield, okay, inflation, etc. So what they do, they just assume, and that is why they get trapped by the manipulators. So whenever they will see, okay, it is moving up, then they will be convinced, okay, now it is moving up, again it is moving up, they will be convinced, and then they will buy, and then all of a sudden there will be the downward movement, a gap down open, heavy gap down open, then immediately upon open, the SP500 it will come down. There will be no chances, absolutely there will be no chances to cover the losses there. So there will be very heavy losses to the retail traders. So this will be more clear on the daily chart. So now again, okay, the divergence. So if you look at the divergence, so the divergence is normal as of now, divergence is not creating any problem. Then comes the volatility. If you again if you look into the volatility, it is 190. So the volatility is 95% of the all-time high level, 95% of the all-time high level, right? So now we have seen that Bollinger Bands bullish, moving average is neutral, Ichimoku cloud bearish, MACD stochastic RSI both are bullish, but stochastic RSI is creating a problem. So now what we will say, that there is a weak bull trend in the S&P 500 on the weekly chart. But again there are some constraints, particularly the K channel of the S&P, the K channel of the stochastic RSI, it is now overheated, it is now saturated. Now guys, let's see what is happening on the daily chart. So now let's do the SP500 technical analysis on the daily chart. in order to confirm or in order to see what is expected to happen on Monday, Tuesday, Wednesday, Thursday and Friday. Now guys, as you know that I give the daily analysis of SP500 to my members who have joined the YouTube membership. So this was the update that I have given to my members on 4th of August. Let's see, on 5th of August, on Friday, only these three scenarios will be seen. Only these three scenarios. And out of these three scenarios, scenario number 1 and 2 are highly likely. Now guys, other than this, in the pre-market update, so I have updated my member that what they can expect from the market, and there was this the job reports. I told them that it is not a good news, it's a bad news, and then I discussed okay these things. Thereafter my members, they asked me okay that why the market is moving up, why it is retracing, why it is not giving up, etc, etc. So I have discussed each and everything in detail. So whatever I have told you in this video in the morning, I have told the same thing already in advance to my members. So they are already aware about these things very well in advance on yesterday itself during the market hours. Guys, other than this, I am giving the regular video updates to my members, the text updates to my members on the daily basis, so that they do not fall into the traps, okay, and then they can make some good money. So if you want to join my YouTube membership, so I've given the link in the description of the video and also in the comment section. So once you click on the link, then this page will open, and on this page you will find this the join button. You can click on the join button. When you click on the join button, then you will see these two options. One is the only one midweek update, and the other one is the all midweek updates. So this is one midweek update per week, this is all midweek update per week. So whenever guys you want to join, you can join, and you will get the daily analysis of SP500, and through that, the daily analysis of the SP500, you can trade safely, you can avoid falling into the traps, and you can make some good money. Now guys, we are back to the S&P 500 chart. This is the daily chart. So this is the daily chart. So daily chart means one candle represents one day, not 1 week or 1 hour. So before I do this, the SP500 analysis, let me tell you the support and resistance levels. First of all, we have a very strong resistance at 4185. This is 4185. This is a very strong resistance for SP500 because number one, it is the calculated resistance. Number two, we have the 200-day EMA, 200-day moving average. And if you have even a little knowledge of that, and if you have even a very little knowledge of the stock market, then you know the importance of the 200 EMA or the 200-day moving average. It is very critical. So this is why the 4185 is going to act as very strong, very critical resistance for the S&P 500, right? Other than that, we have that immediate resistance at 4150. Just look at the right side, 4150, this 4149 or 4150. The closing of the S&P 500 was 4145. Then we have a support at 4110, and this is what I told my members yesterday, that see, we have a support at 4110, right? Then we have our next support at 4065. Then we have a good support at 4035. This is 4035. Then the next support comes at 3990. Sorry, this next support it is at 3990. Then we have 3938 or 3935, the next support, and so on. So as of now, I'm expecting that when the S&P 500, okay, it comes down, and if we measure, okay, and if we measure like minimum 5% fall, then in that case, that 5% will be approximately, okay, at this level, at 3935. But if there comes a heavy movement, then this 5% will not be there. Then there will be a 10%, and the 10% will be somewhere around, this level. So we have next support at 3884, and then the next support at 3840, 3840. Then the next support, okay, it comes around these particular levels. So that means if we are looking for the 10% fall, then the 10% fall within a week, okay, or within 2 weeks, it will be from, so the 10% fall will be approximately to this level. That was the previous low, okay. This was almost the previous low, that So that was the previous low. So this was almost so this was 17th of June, okay, 16th of June 2022. And as I've already mentioned that earlier, the 200 week moving average, 200 week moving average, it was there. So this time whenever the SP500 it comes down, it will breach the 200 week moving average and it will head towards 3500 or 3300. Okay, so this thing is clear. Now so these are the support and resistance levels. Now so guys, again, if you are new to my channel, okay, or if you are subscribed recently, then let me tell you about the support and resistance levels once again, that the support and resistance levels are not the standard support and resistance level that comes through this the chart or this the indicator, and these are not the pivot levels. This is something that I've calculated by analyzing the last 100 years of data of S&P 500. So earlier the S&P 500 it was S&P 2 it was S&P 95, then it was S&P 233, and then it became S&P 500. So the total history of the S&P 500 is 100 years. So I have analyzed the data since then, and then only I've calculated, and that is the reason. That is the reason why you will see that the S&P 500 it always respect not just the S&P 500 but the Dow Jones. Okay, so I have different levels for the Dow Jones. That the Dow Jones and the S&P 500 index, these indices they respect these the support and resistance levels. Now let's do the S&P 500 technical analysis on this the daily chart. First comes the Bollinger Bands. This is the upper band. This is the median. Because the S&P 500 has closed between the upper band and the median, this means that the S&P 500 is bullish through the Bollinger Band. Then comes the moving averages, clear fan out, and the closing is above the moving averages. Again, bullish through moving averages. Successive closing above the Ichimoku cloud means the S&P 500 is bullish through the Ichimoku cloud. Now some other technical indicators. MACD, because both the MACD and the K channel, because both the MACD and signal both are positive, it is bullish. K channel, MACD is more than the signal. This means that the directional MACD is bullish. Then comes the stochastic RSI. Now in this week, the K channel is more than the D channel. This means it is bullish, and the K is 95 and the D is 93. Okay, so this means that as of now it is not saturated. Then comes the divergence. Divergence is normal. Then comes the volatility. Volatility, it has come down. So volatility, as of now, the volatility is 60 to 65% of the all-time high levels, right? So through all of the technical indicators, it is clear that the S&P 500 is bullish. Now let's deduce the probable movement of the S&P 500. Now guys, there is one more important thing that I want to share with you, that this is the S&P 500 knowledge transfer program, and if you want to learn about the S&P 500, the movement of the S&P 500, the technical indicators, how they work on the S&P 500, not just on S&P 500 but on Dow, okay, on stocks, and other than the trading strategies, if you want to learn about the trading strategies for the S&P 500, for Dow Jones, for the stocks, and support and resistance, then the market analysis means the S&P 500 analysis, how to do the S&P 500 analysis, that how to deduce the probable movement of the S&P 500 through the options, then the S&P 500 hacks or overall the stock market hacks means whenever you see like some patterns, then definitely there will be something that will happen on the next day. That is 100% certain. No one can change. So if you want to learn all of this, so even if you are a beginner, even if you do not know anything about the stock market, then also you can participate in the program. Now there is one important thing, that there will be sessions, and each session will be of 2 hours, and this will not happen every day. I will schedule this thing with you. So these are some important terms and conditions. Okay, now guys, these are some examples. Okay, these are the sessions. So I have taught these people, okay, this the S&P 500 movement, technical indicators, etc. So these are the examples, okay, and these are the terms and conditions. And guys, whenever you want to participate in the S&P 500 knowledge transfer, so you can simply drop me an email. This is my email address. Now let's deduce the probable movement of the SP 500. So now in the coming week, what we have seen on the weekly chart, that the K channel, it is saturated. K channel is 100 and it is indicating a reversal. Number one. Number two, what we have seen is that through this economic data, because now the market is fearful, and because the 2-year bond yield, it is 9.19% up, heavily, very very heavily up. This means that the market movers, the hedge funds, okay, these are the big people, they have withdrawn the money from the stock market and they have pumped the money back into the bonds, right? This is the only reason why it is up by 9.19%. This again indicates that through the bond and through this the job data, we are expecting a reversal in the S&P 500. Okay, so these two things are these two things are very much clear. Now technically, what can happen and what cannot happen, let me tell you. Number one, you need to notice that S&P 500, it failed 1, 2, 3, 4, 5, 6, 6 candles. 6 candles. Okay, and what it failed? It failed 4177.51. Now, what is this, the 4177.51? This is the previous high of the consolidation zone. This was the previous consolidation zone, and this was the high of the consolidation zone. So the high of the consolidation, this is the high of the consolidation zone. It was 4177.51. Until and unless S&P 500 breaches and closes above 4177.51, it is not going to be bullish. It cannot be bullish. And this is what I told you last week, and this is what I'm telling to my members every other day through the daily SP500 technical analysis. And now you can see, and now you can clearly see 1, 2, 3, 4, 5, 6. On 6 days, SP500, it tried to move up to breach 4177.51, but it failed to even touch 4177.51. The high it made, it was 4167. And now, because we have this the economic data and we have this the K channel 100, now the chances are very very less, and that is the reason why we are anticipating a fall in the S&P 500. So as of now, on Monday, we are not sure whether there will be a gap up open or the gap down open. But yes, if there comes a gap down open, or if there comes a heavy gap down open, then be ready to see some good selling in the market. Immediately upon this the gap down open, there will be the selling in the market. See, you need to understand that this movement, it was a manipulated movement. It was a fake run. It was the fake run. So the market manipulators, in order to trap more retail traders, what they can do, they can give a flat open, or maybe just a bit gap down or the gap up open, and then immediately they can try to move up the market, means the S&P 500 index. When it will try to move up, then the retail traders, again the problem with the retail traders is that the retail traders, they are impatient. They are looking into the 1-minute candle, 5-minute candle, and they participate in the rat race, and there is fear of missing out. When they will see that the S&P 500 is moving up, then they will not think about any technical or anything. They will participate in this the buying. So when they will buy, now when the retail traders, they will buy, so there will be some good volume. When the volume will be there, then after some time, the market manipulators, because see, eventually market manipulators, they have to give up. They have to give up, and then they need to sell. So after some time, what the market manipulators will do, so once they have the enough volume, then simply they will bring down the market. You can easily manipulate the retail traders. Anyone can manipulate the retail traders. But now question is that what about these the chart pattern traders, okay, or the traders, okay, who look into the technicals? What about these people? Now, in order to trap these people who look into the charts, who look into the technical indicator, the market manipulator will force the market, means the market manipulator, they will force the S&P 500 to hit 4177.51, or maybe you will see that the S&P 500, it is breaching the 4177.51. Now that will create panic into the chart pattern traders, because they are looking into the technical. They were looking for the 4177.51. In that case, what my advice is that let it breach, not a problem. Let it breach, let it move up, not a problem. Wait for the closing. Wait for the closing. Why the closing is important? Because the closing tells you what is expected to happen in the stock market in the coming days. or on the immediate basis. Now there will be very heavy chances that the closing will be below 4177.51. It will be able to breach, but the closing will be below 4177.51. That will again be considered, that will be again accepted as a rejection, seventh or eighth rejection in a row. Okay. Other than that, you can also see that whenever it breaches 4177.51, it will move towards 4185. Now when it moves towards the 4185, in that case it can hit the 4185. And what is 4185? 4185 is a calculated resistance and the 200-day moving average. It can hit the 200-day moving average. Now what will happen after hitting the 200-day moving average? Immediately there will be a reversal. Again there will be a reversal. Technically there comes a reversal and there will be a reversal. See, as of now, again let me remind you that the stock market, because there is no meeting of these the Feds in the month of August, means the S&P 500 will remain volatile, SP500 will remain speculative, SP500 will remain manipulative. So again do not get surprised if you see surprises. And that is the reason why I always recommend to use a tight stop loss. Now the question is that when you should be bullish, that when you should enter into the S&P 500 as a bull. You should enter into the S&P 500 as a bull when you see two consecutive closings above the 200-day moving average, above 4185. Because when there will be two consecutive closings above 4185, so that will simply clear the consolidation zone, that will clear the 200-day moving average, that will clear this the resistance, and then only we can expect the SP 500 to move up, okay, towards 4250 or 4300, etc. But as of now, those chances are very less. But still, again remember, volatile, speculative, and manipulative. So manipulators will do everything that they can in order to trap the retail traders, in order to trap the chart pattern traders. Okay. So this thing is with this the upward movement. Now what about the downward movement? So the downward movement is, if you see that there is a very heavy gap down open, and yes, we can anticipate a gap down open, because if you see that overnight they have bought, these the big players, they have pumped a lot of money into these the bonds overnight. So we can anticipate a very heavy a very heavy gap down open on 8th of August. Okay, then once we see this the gap down open on the heavy gap down open on 8th of August, immediately upon this the gap down open, there will be a fall. And this is what I was trying to tell you. This is how the market manipulators, they manipulate. What they do, that yesterday they have formed this the bull candle. So they have tried to convince you through this the bull candle that, see, this is the job data, okay, this is good, and there will be no impact on the stock market, there will be no impact on the SP 500, so you need not to worry and feel free to be bullish. This is what they tried to tell you. But what was the purpose? When there comes a very heavy gap down open, then immediately with this the gap down open, they will sell. So immediately upon the gap down open, they will be selling in the S&P 500. Means whosoever has bought yesterday, was bullish yesterday, he will be trapped and he is going to lose a lot of money. So this the second scenario is that if there comes a heavy gap down open, then we will see selling, very heavy selling. Thereafter, and whenever it comes down, then first it will find support at 4110. If the gap down open is below 4110, then it will find support at 4065. Because when it will be hitting the 4065, it will also hit this the red moving average. Thereafter, it will breach this the red moving average. It will come and it will hit this the 4035. So within a day, how much it can lose? So it can lose, like if it comes down to this level, approximately 2.67% or 2.5%, you can say in simple terms. So 2.5% or 2.67%. So the S&P 500 can lose 2.5% to 2.6% within a day. So that is normal. So now whenever it comes down, so it will come down to this the 4035, then it will find this this moving average here at 4035. Now these two will provide some strong support to the S&P 500. So on Monday you can expect that if it happens, then it will come and find support at 4035. Now on Tuesday, what will happen? Just like what happened earlier, a very heavy gap down open, then come down. So on Tuesday, again on Tuesday you can expect a gap down open and then again a fall. On Tuesday itself, it can come down to this level, this particular level, and this will be 3935. Now again on Tuesday it will come down only and only if there is this kind of movement that we have anticipated on Monday. That first there must be a heavy gap down open. Immediately upon gap down open, it should come down to hit 4035 or around 4035. Okay, when this happens, then on Tuesday you can expect a further this the downward movement. And then on Wednesday also, sorry, not on Wednesday, because on Tuesday it will find support here. Then on Wednesday you can either expect a reversal or a small movement, and if not, then again expect a downward movement to 3840. So this is like 6 to 7% or 8% fall you can expect in the S&P 500 in the coming week. So this will be the second scenario. So the first scenario is this, the upward movement, and then it will come down. The second scenario, that it will come down and come down. Now comes the third scenario. So the third scenario is the consolidation. Third scenario is the consolidation. Now the third scenario is the consolidation. Now what is consolidation? What the consolidation is that the S&P 500, it is neither moving up nor it is coming down. It is just range bound. So for example, so let's say it is trading between 4065 and 4150 or 4177.51. So it is trading in between these two levels, but it is neither moving up, it is neither bullish nor bearish. So it is creating some kind of confusion there. So the consolidation will come only and only when the market manipulators, they want to trap more and more retail users. And why they will do that? Because of the volume. See, the market manipulators, they have a weakness. And what is that weakness? Weakness is the volume. They have billions of dollars. Okay, whereas the retail traders, okay, they have like hundreds of millions of dollars, okay, or a few billion dollars. Now whenever these the market manipulators, they want to sell, they need enough volume to make sure that they can sell each and every penny, each and every stock. And if they think that there is not enough volume in the market, in this the S&P 500, in that case they will try to hold the S&P 500. They will try to push the S&P 500 into the consolidation. And what will happen with what will happen in this the consolidation? These again the retail traders. So the retail traders will give the required volume to the market manipulators. But again in this the consolidation you can still make money, because see, the K channel is 100 on the weekly chart. This means that S&P 500 will come down. It has to come down. It has to cool down. Means overall you can expect a bearish candle. On the weekly chart for the coming week, that is the week of August 8. You can expect a bearish candle, because only a bearish candle, or not just bearish candle, but a heavy bearish candle can cool down the K channel on the weekly chart. So I'm not saying 10%, even 3% or 4%, okay, on the weekly basis down. So that will also cool down the K channel on the K channel in this the case of the stochastic RSI on the weekly chart of SP 500. So guys, these are the scenarios. So guys, there is one more thing. I will strongly recommend you to write the comments if you have any questions that you want to ask, and I will try to answer each and every comment. Also guys, if you have not joined my YouTube membership, then in order to get the daily S&P 500 analysis, you can join my YouTube membership. And also guys, if you have not subscribed to my channel, then please subscribe the channel and click on the bell notification icon, so that whenever I upload this the weekly technical analysis and other informative videos like S&P 500 manipulation, the technical indicators, then you will get these the timely notifications, and you can watch and you can enhance your knowledge. You can learn a lot of things and you can avoid falling into the traps. So guys, this was my S&P 500 technical analysis from August 8, 2022 to August 12, 2022.